Picture this. If you took every dollar of debt owed by every government on Earth and stacked those dollar bills on top of each other, the tower would stretch from the ground to the moon and back again over 4,000 times. We're talking about roughly $100 trillion of sovereign debt, money that nations owe to someone, somewhere. But here's the truly mind-bending part. If you tried to figure out exactly who all this money is owed to, you'd discover something that sounds like the plot of a financial thriller. Countries owe money to their own citizens, to other countries, to banks that create money out of thin air, to pension funds managing retirement savings, to insurance companies, to wealthy individuals you've never heard of, and to institutions so complex that even economists struggle to understand them. Some of this debt is owed to entities that didn't exist when the debt was created. Some is owed to the very governments that borrowed the money in the first place. And some, this is where it gets really weird, is owed to no one at all. Welcome to Professor Archive, where we unravel the mysteries that shape our modern world. I'm your host, and I'm about to take you down a rabbit hole that leads to the very heart of how money, power, and nations really work. Because the story of why every country is in debt isn't just about economics. It's about the greatest financial magic trick ever performed. One so sophisticated that most people don't even realize it's happening. The question isn't really why countries are in debt. The question is, how did we create a world where being debt-free would actually be a sign that something is terribly wrong with your economy? To understand this paradox, we need to travel back to a time when debt was simple, personal, and often deadly. In ancient Mesopotamia, if you couldn't pay what you owed, you might be sold into slavery along with your family. Debt was a concrete thing. Grain borrowed during a famine, silver borrowed to buy tools, goods borrowed against future harvests. The lender was a real person, the borrower was a real person, and the consequences of default were immediate and brutal. But even in these early civilizations, rulers discovered something fascinating. The power to forgive debt was almost as valuable as the power to collect it. Babylonian kings would periodically declare debt jubilees, wiping out all debts across their kingdoms. This wasn't charity, it was smart politics and economics. Too much private debt would eventually destroy the tax base and make the kingdom vulnerable to invasion. The real transformation began when governments themselves started borrowing money. And this is where our story takes its first dramatic turn. The first sovereign debt crisis in recorded history happened in the 4th century BCE when the Greek city-states borrowed heavily to fund their endless wars. When they couldn't pay, something unprecedented happened. The creditors couldn't exactly repossess a city-state. This created the fundamental difference between personal debt and sovereign debt that still exists today. When you or I borrow money, we put up collateral. A house, a car, something the lender can seize if we don't pay. But what do you seize from a country? The army? The tax system? The people themselves? Medieval Europe developed creative solutions to this problem. Italian city-states like Venice and Genoa created some of the first government bonds, essentially IOUs that could be bought and sold like commodities. But the real innovation came from an unexpected source. The Knights Templar, the warrior monks of the Crusades. The Templars created the first international banking system, allowing pilgrims to deposit money in one country and withdraw it in another. They also became massive lenders to European monarchs, funding their crusades. When King Philip IV of France found himself deeply in debt to the Templars in the early 14th century, he solved the problem in the most medieval way possible. He had them all arrested on charges of heresy and seized their assets. This established another pattern that continues today. The relationship between sovereign borrowers and their creditors is always political, never purely financial. The Templars learned this the hard way when their debtors became their executioners. But the real revolution in sovereign debt came with the establishment of the Bank of England in 1694. Here's where our story gets genuinely weird, because the Bank of England was created specifically to lend money to the English government, but it was owned by private investors who were lending money that didn't actually exist. Let me explain how this worked, because it's so counterintuitive that it sounds like a scam. A group of wealthy merchants agreed to lend the English government £1.2 million to fund its war against France. In exchange, they received a charter to operate as the Bank of England and the right to issue banknotes, essentially to create money. They lent the government money that they created by lending it to the government. This circular logic became the foundation of modern banking and the reason why sovereign debt became so complex. The bank created money by creating debt, and the debt was secured by the government's promise to honor the money the bank created. It's a system so sophisticated that even today, most people don't fully understand how it works. The Bank of England model spread across Europe and eventually the world, but each country developed its own variations. The French tried a different approach under John Law in the early 18th century, creating a system where government debt was backed by colonial land speculation. When the Mississippi bubble burst in 1720, it nearly destroyed the French economy and created a national trauma about paper money that lasted for generations. Meanwhile, the Dutch developed what might have been the world's first modern bond market, where government debt could be bought and sold like stocks. Amsterdam became the financial capital of Europe not because the Dutch had the most money, but because they had created the most sophisticated system for managing debt. But the American Revolution created an entirely new type of sovereign debt problem. The Continental Congress needed to fund a war but had no established government, no tax base, and no credibility with foreign lenders. Their solution was to print money backed by the promise of future independence, essentially creating debt backed by hope. When the war ended and the United States actually won independence, Alexander Hamilton made one of the most controversial decisions in financial history. He insisted that the new federal government honor all the debt created by the Continental Congress and the individual states, even though much of this debt had been sold to speculators for pennies on the dollar. Hamilton's critics, led by Thomas Jefferson, argued that this was essentially a massive transfer of wealth from taxpayers to speculators. But Hamilton understood something crucial. A nation's creditworthiness is its most valuable asset, and once lost, it's almost impossible to regain. This brings us to one of the most important principles of sovereign debt. Countries borrow money not because they have to, but because they can. The ability to borrow money is a sign of strength, not weakness. It means that investors believe in your country's future and its ability to generate enough economic growth to pay back what it owes. The 19th century proved this principle repeatedly. Britain borrowed enormous sums to fund the Napoleonic Wars, but its victory made British bonds the safest investment in the world. The British pound became the global reserve currency, and London became the world's financial center, not despite Britain's debt, but because of how well Britain managed it. On the other hand, countries that couldn't borrow money were often countries in crisis. The Ottoman Empire's financial difficulties in the 19th century weren't just a symptom of its decline, they were a cause of it. Without access to credit, the Ottomans couldn't invest in modernization, couldn't build railways or factories, couldn't compete with European powers that could fund long-term projects with borrowed money. But the 20th century brought challenges that no previous generation had faced. 2 world wars that cost more than any previous conflicts in human history. World War I alone cost the major powers more than all their previous wars combined, and it had to be funded almost entirely with borrowed money. This is where sovereign debt became truly global for the first time. The United States, which had been a debtor nation for most of its history, suddenly became the world's largest creditor. European powers that had dominated global finance for centuries found themselves owing enormous sums to American banks and the American government. The interwar period saw the first modern sovereign debt crisis when Germany, crushed by war reparations and economic mismanagement, experienced hyperinflation so severe that money became literally worthless. People carried wheelbarrows full of cash to buy bread, and the psychological trauma of this experience would shape German economic policy for generations. But World War II created an even more fundamental transformation. The Bretton Woods system, established in 1944, made the US dollar the world's reserve currency, backed by gold and guaranteed by American economic dominance. This system lasted until 1971, when President Nixon ended the dollar's convertibility to gold, creating the modern era of purely fiat currency. Here's where our story takes its most dramatic turn, because Nixon's decision fundamentally changed the nature of sovereign debt. When money was backed by gold, there were natural limits to how much debt a country could accumulate. But when money became purely a matter of trust and accounting, those limits disappeared. Modern sovereign debt exists in a world where money is created by central banks through a process that sounds like magic, because in many ways, it is magic. When the Federal Reserve wants to increase the money supply, it doesn't print physical dollars. It simply credits the accounts of commercial banks with digital dollars that didn't exist moments before. This process, called quantitative easing, became especially visible during the 2008 financial crisis and the COVID-19 pandemic. Central banks around the world created trillions of dollars, euros, yen, and other currencies to purchase government bonds, essentially allowing governments to borrow money from themselves. But here's where it gets really mind-bending. When the Federal Reserve buys U.S. Treasury bonds, who exactly is the U.S. government in debt to? The Federal Reserve is technically independent, but it's also a creation of the U.S. government, and its profits are returned to the U.S. Treasury. So, in a very real sense, the U.S. government owes money to itself. This isn't just an American phenomenon. The Bank of Japan owns more than 50% of all Japanese government bonds. The European Central Bank owns hundreds of billions of euros worth of European government bonds. China's central bank owns massive amounts of Chinese government debt. The pattern is global and unprecedented in human history. So when we ask who countries owe money to, the answer is increasingly themselves. But this circular logic has created new problems and new debates about whether sovereign debt even matters anymore. Modern monetary theory, a controversial economic framework that has gained popularity in recent years, argues that countries that control their own currencies can never really go broke because they can always create more money to pay their debts. Critics argue that this is a dangerous delusion that ignores the reality of inflation and international markets. But even traditional economists acknowledge that sovereign debt works differently today than it did in the past. When Japan's debt to GDP ratio exceeds 250%, higher than any major economy in history, yet Japanese government bonds are still considered among the safest investments in the world. It suggests that old rules about sustainable debt levels may no longer apply. The key insight is that sovereign debt is not like household debt, and the intuitions we have about personal finance can be misleading when applied to countries. When you or I borrow money, we're taking resources from our future selves to use today. When a government borrows money, it's often creating resources that wouldn't otherwise exist. Consider infrastructure spending. When a government borrows money to build roads, bridges, schools, or hospitals, it's not just consuming resources, it's creating assets that will generate economic value for decades. The debt is matched by real productive infrastructure that makes the entire economy more efficient. Or consider deficit spending during recessions. When a private sector demand collapses, government borrowing can maintain economic activity that would otherwise disappear. The debt incurred today prevents a deeper recession that would be more costly in the long run. But not all sovereign debt is created equal, and this is where the story becomes more complex. The debt that rich countries owe to themselves or to their own citizens operates under different rules than the debt that developing countries owe to foreign creditors. When Greece faced its debt crisis in 2010, the problem wasn't just the amount of debt, it was that much of the debt was denominated in euros, a currency that Greece couldn't create. This gave foreign creditors enormous leverage over Greek economic policy and led to years of austerity measures that devastated the Greek economy. Similarly, many developing countries borrowed heavily in US dollars during the 1970s and 1980s, thinking that their growing economies would make repayment easy. But when the Federal Reserve raised interest rates dramatically in the early 1980s, the cost of servicing these dollar-denominated debts became crushing, leading to the Latin American debt crisis that saw countries like Mexico, Brazil, and Argentina struggle with unpayable foreign debts. This brings us to one of the most important distinctions in sovereign debt: domestic versus foreign creditors. When a country owes money to its own citizens, the debt represents a redistribution of wealth within the country. When a country owes money to foreign creditors, the debt represents a transfer of wealth from the debtor country to the creditor country. The composition of creditors has also changed dramatically over the past several decades. In the 1970s, most sovereign debt was owed to commercial banks. Today, the largest holders of government bonds are often pension funds, insurance companies, and sovereign wealth funds. institutions managing money for millions of ordinary citizens. This means that when we ask who countries owe money to, the answer is often their own people. The pension fund managing your retirement savings probably owns government bonds from multiple countries. The insurance company that will pay your life insurance claim owns government bonds to match its long-term liabilities. The sovereign wealth fund that manages your country's oil revenues owns bonds from countries around the world. China has become the most visible foreign creditor in recent years, lending hundreds of billions of dollars to developing countries through its Belt and Road Initiative. But even Chinese lending is more complex than it appears. Much of this debt is owed to Chinese state-owned banks, which are themselves funded by Chinese government deposits, which are themselves backed by Chinese foreign exchange reserves, which are themselves largely invested in U.S. Treasury bonds. The interconnectedness of global debt markets means that a crisis in one country can quickly spread to others. When Argentina defaulted on its bonds in 2001, it affected pension funds in Italy that had invested in Argentine debt. When Russia invaded Ukraine in 2022, it affected the global food and energy markets that many countries depend on to service their debts. But perhaps the most surprising aspect of modern sovereign debt is how much of it is held by central banks. The Federal Reserve owns more than 20% of all U.S. government debt. The Bank of Japan owns more than 50% of Japanese government debt. The European Central Bank owns hundreds of billions of euros worth of European government bonds. This means that a significant portion of sovereign debt isn't really debt in the traditional sense. It's an accounting relationship between different branches of the same government. When the Federal Reserve buys treasury bonds, it's essentially the U.S. government lending money to itself, paying interest to itself, and owing money to itself. The COVID-19 pandemic accelerated these trends dramatically. Governments around the world borrowed unprecedented amounts to fund emergency economic support, while central banks created unprecedented amounts of money to buy government bonds. The result was a massive expansion of both sovereign debt and central bank balance sheets. But instead of creating inflation or financial instability, as traditional economic theory would predict, this massive monetary expansion was largely absorbed by a global economy desperate for safe assets. Government bonds remained in high demand, even as governments issued them in record quantities. This suggests that the traditional constraints on sovereign debt may have fundamentally changed. In a world where private savings exceed investment opportunities, where demographics are aging rapidly, and where inequality is concentrating wealth in the hands of those who prefer safe assets, government bonds serve a crucial function that goes beyond financing government operations. They provide the safe, liquid assets that pension funds, insurance companies, and wealthy individuals need to store value over long periods. Without government bonds, these institutions would have nowhere to put their money safely, which could create financial instability and economic stagnation. This is why some economists now argue that government debt isn't a burden on future generations. It's a service provided to current generations who need safe places to store their wealth. The debt that one generation owes to itself becomes the inheritance that it passes to the next generation. But this doesn't mean that sovereign debt is risk-free or that countries can borrow unlimited amounts without consequences. Currency crises, inflation, and political instability can all result from excessive borrowing, especially when debt is denominated in foreign currencies or owed to foreign creditors who can withdraw their support quickly. The key is understanding that sovereign debt operates according to different rules depending on the economic and political context. A country like Japan can sustain debt levels that would be catastrophic for a country like Turkey, because Japan has its own currency, a domestic savings surplus, and credible institutions. Similarly, the United States can sustain enormous debt levels partly because the US dollar is the world's reserve currency, meaning that foreign countries and institutions need to hold dollars for international trade and finance. This creates automatic demand for US government bonds regardless of their yield or the size of US debt. The euro area represents a unique experiment in sovereign debt, where countries share a currency but maintain separate fiscal policies. This has created tensions that became visible during the European sovereign debt crisis, when countries like Greece and Ireland found themselves unable to devalue their currencies or print money to ease their debt burdens. China presents another unique case, where most government debt is owed to domestic institutions that are themselves controlled by the Chinese government. This gives Chinese policymakers enormous flexibility in managing debt crises, but it also means that the distinction between government debt and private debt becomes blurred. Looking at the current global situation, we see that sovereign debt levels are higher than they've ever been in peacetime, but they're also distributed and managed differently than ever before. The largest creditors are often the most stable institutions in the global financial system: central banks, pension funds, and sovereign wealth funds that have long-term perspectives and little incentive to create financial instability. This has created a situation that would have seemed impossible to earlier generations. Countries can maintain extremely high debt levels while enjoying historically low borrowing costs. The United States currently pays less than 2% interest on its 10-year bonds, despite having debt exceeding 100% of GDP. Japan pays less than 1%, despite having debt exceeding 250% of GDP. These low interest rates reflect several factors: aging populations with high savings rates, slow economic growth that reduces investment opportunities, and central bank policies that keep interest rates low to stimulate economic activity. But they also reflect confidence that major governments will honor their debts regardless of the amounts involved. The implications of this new debt environment are still being debated by economists and policymakers. Some argue that high government debt levels are necessary to absorb excess private savings and prevent economic stagnation. Others worry that excessive debt will eventually lead to inflation, financial instability, or intergenerational injustice. The COVID-19 pandemic provided a real-world test of these theories. Governments borrowed enormous sums while central banks created money on an unprecedented scale. Traditional economic theory predicted that this would cause inflation and financial instability, but the immediate results were more complex. Some countries did experience inflation, but it was often related to supply chain disruptions and energy price spikes rather than monetary expansion. Financial markets remained relatively stable despite the massive increase in government borrowing. And economic recovery was faster in countries that borrowed heavily to support their economies during lockdowns. This suggests that the relationship between sovereign debt and economic outcomes is more complex than traditional models assumed. The ability to create money, the nature of creditors, the currency denomination of debt, and the broader economic context all matter more than simple debt-to-GDP ratios. As we look toward the future, several trends are likely to shape the evolution of sovereign debt. Aging populations in developed countries will increase demand for safe assets like government bonds, while also increasing government spending on healthcare and pensions. Climate change will require massive government investments in infrastructure and energy systems. Technological disruption may require new forms of social spending to support displaced workers. All of these trends suggest that government borrowing will remain high for the foreseeable future. But they also suggest that the nature of debt will continue to evolve as governments, central banks, and financial markets adapt to new realities. The question isn't whether countries will continue to be in debt. They almost certainly will. The question is whether we can manage this debt in ways that promote economic growth, financial stability, and social welfare while avoiding the crises that have plagued previous generations. Understanding who countries owe money to is crucial for answering this question. When debt is owed to domestic savers through stable institutions, it can be managed very differently than when it's owed to foreign creditors who might withdraw their support during crises. The complexity of modern debt relationships also means that simple solutions are unlikely to work. Calls to eliminate government debt ignore the crucial role that government bonds play in the financial system. But calls to ignore debt levels entirely ignore the real constraints that countries face, especially smaller countries that don't control reserve currencies. What emerges from this analysis is that sovereign debt is not a simple problem with simple solutions. It's a complex system that reflects the broader organization of modern economies and societies. Understanding this system requires moving beyond intuitions based on household finance to appreciate the unique characteristics of sovereign debt in a world of fiat currencies, global financial markets, and interconnected economies. The story of sovereign debt is ultimately the story of how human societies organize themselves to coordinate economic activity across time and space. When governments borrow money, they're making bets about the future, that economic growth will make repayment possible, that social and political institutions will remain stable. that the complex web of relationships between creditors and debtors will continue to function. These bets have generally paid off throughout history, not because governments are uniquely trustworthy, but because the alternatives to a functioning sovereign debt system are so much worse. Without the ability to borrow against future economic growth, governments couldn't invest in infrastructure, education, or research. Without safe government bonds, savers would have no secure place to store wealth for retirement or other long-term needs. The magic trick that makes sovereign debt work is not really magic at all, it's trust. Trust that governments will honor their commitments. Trust that economies will continue to grow. Trust that the complex institutions managing these relationships will continue to function effectively. This trust is never absolute and always fragile. It can be lost quickly through war, political instability, or economic mismanagement. But it can also be maintained and strengthened through good governance, sound economic policies, and transparent institutions. The countries that understand this, that treat their creditworthiness as a valuable national asset to be protected and preserved, are the ones that benefit most from the sovereign debt system. They can borrow at low rates to invest in their futures while providing safe assets to savers around the world. The countries that abuse this trust, that borrow recklessly, default on their obligations, or use debt to fund consumption rather than investment, find themselves excluded from global capital markets and forced to rely on their own limited resources. In the end, the question of who countries owe money to reveals something profound about how modern societies work. We are all creditors and debtors to each other, bound together by complex financial relationships that span borders and generations. The government bonds in your pension fund represent your country's promises to future taxpayers. The currency in your wallet represents your country's promise to honor its debts. Understanding these relationships doesn't make them less mysterious, but it does make them less frightening. Sovereign debt is not a conspiracy or a scam. It's a tool that human societies have developed to coordinate economic activity in a complex world. Like any tool, it can be used well or poorly, but it cannot be easily discarded without losing the benefits it provides. That concludes our journey through the labyrinthine world of sovereign debt here at Professor Archive. From ancient Mesopotamian grain loans to modern central bank balance sheets, we've explored how the simple concept of borrowing money became one of the most complex and crucial systems in the modern world. If this deep dive into financial mysteries has opened your eyes to how money and debt really work, make sure to subscribe and hit that notification bell. We've got many more investigations into the hidden mechanisms that shape our economic reality. What surprised you most about who really holds sovereign debt? Share your thoughts in the comments below, and remember, in a world where every country is in debt, the real question isn't who owes what to whom, but whether we can maintain the trust that makes the whole system work. Until next time, this is Professor Archive reminding you that the most powerful force in economics isn't supply and demand, it's trust.